I'm Brittany Lewis with Forbes Breaking News. Joining me now is Stephen Mathai-Davis, the founder and CEO of Q.ai. Q.ai is a next-gen AI-powered investing app that's backed by Forbes. Stephen, thank you so much for joining us today.
Thanks for having me on, Brittany.
So on Wednesday, June CPI report was released, showing inflation hit a 40-year high, spiking 9.1% year over year.
Yep.
So this increase was way worse than expected. And just point blank, do you think it's going to get worse next month?
Is it going to get worse next month? No, but we know that this is backwards looking.
Sure.
We already see that gasoline prices are dropping. Spiking gasoline prices were the major driver increase in headline CPI last month. So the answer is no, because empirically, the main driver of it is actually decelerating.
So you're saying it's not going to get worse. After the report was released on Wednesday, House Speaker Nancy Pelosi said that inflation has peaked. Back in December, President Biden told CNN that it has peaked. But should Americans be bracing for more inflation, or do you think the data is suggesting that it's peaked and now we're going to move back down, no more inflation?
Well, I want to be careful. There are a couple drivers in inflation.
Sure.
So we're talking about gasoline prices, which drove the big jump in June. We know that's coming back because gasoline prices already in July have been pulling back. Mm-hmm. And we were really bullish in gasoline. And I've come on the show and I've talked about being long gasoline was one of our best trades at Q.ai. Long gasoline, hedging it with the short in oil. But food prices continue to increase, shelter prices continue to increase. So those are going to continue to be drivers of inflation. Is it going to accelerate from here? No. Is it going to decelerate sharply? The evidence doesn't suggest that either.
You're talking about gas prices decreasing. Do you think Americans will be able to see less pain at the pump?
They're already seeing less pain at the pump, but it's all relative. Again, year over year, it's high. But on a relative basis, so period over period, week to week, yes. And you're already seeing that.
So I want to talk about a glimmer of hope in June's CPI report, and that is the core CPI data. Can you touch base on that?
Sure. Remember, the core CPI, people talk about it because it's more steady, it's less volatile than the headline, because oil prices are energy prices, and food prices tend to be much more volatile. So the core CPI, year over year, showed a slight deceleration in June. Period over period, so that's in comparison to May, it ticked up a little bit. But it's much lower than the headline number, which is obviously offering a glimmer of hope when we think about economic growth going forward.
This was a glimmer of hope, but overall the report was worse than expected. So I've asked you every week, point blank, do you think we're headed to a recession? And you have said no. But because the data was worse than anticipated, do you think we are headed to a recession?
Empirically, the evidence actually does not point towards a recession. That's why we continue to say it's a soft landing at Q.ai. If you look at retail sales, they continue to grow period over period. Wage growth continues to be strong. Yes, they're both lagging inflation, but we're talking about factors that may pull back the rate of increase in inflation anyways.
And you were saying that you don't see a recession coming, and other economists this week, including at Goldman Sachs, also believe that there isn't an imminent recession in 2022.
Can I touch on that for a second?
Yeah.
That's coming back to what we talked about last week, which is the GDI print has changed everyone's perception, right? Because GDI is another measure of economic output. It's the bottom-up measure.
Okay.
It's more robust. It's just like in stock valuation. A bottom-up valuation is much more robust and detailed-oriented than a top-down. And you have to think about GDP as the top-down valuation of economic output in the economy. GDI is a bottom-up. GDI was positive for 2Q in comparison to a negative print for GDP. Historically, GDP tends to converge towards GDI when there's a divergence.
According to a new survey released today, nearly half of economists are saying that they do see a recession in 2022. So can you speak to this disconnect that we're having here, or what angle or data are they missing that you're seeing?
I'm not sure if there's a divergence, right? Because what you're seeing is actually revisions are more positive. So what you were talking about earlier, people are actually revising their estimates for 2022 and suggesting, okay, we're not going to have a recession in 2022, which is what we've been arguing. Nobody's arguing for go-go growth. It's just, are we going to be in a recession in 3Q or 4Q? And the evidence doesn't point to that at the moment.
And is the evidence pointing, sure, maybe 2022 is safe, but what about 2023?
If you look at the S&P 500, earnings growth is expected to be in the mid to high teens for the next 12 months. Interestingly enough, when you move forward beyond that, expectations for earnings growth drop down to mid-single digits.
Okay.
That's pointing towards something in the economy decelerating corporate profits. So when I look out to 2023, 2024, we're not making a habit of forecasting that far. I would definitely be cautious about that. But when I look forward over the next quarter to 2 quarters, which is what we're doing as we're positioning a lot of our investment strategies, we don't see the risk of a recession being greater than 50%.
You're saying that you don't want to forecast too much out, but within 6 to 8 months is the midterm election, and all bets are off on what's going to happen there. So do you think a change in Congress will impact this at all?
I think regulations certainly will impact it. I think the bigger concern, if I may, without reading the papers of some of these economists are concerned about economic growth in 2023 and 2024, it's pretty simple. Wage growth is actually lagging inflation. Retail sales is positive in nominal terms. It's lagging in real terms. It's simply a factor of inflation accelerating faster than both of those. And that's worrisome if that continues for another 12 to 18 months. And I'm sure that's what they're concerned about when they look out to 2023 and 2024, because it's not sustainable. But again, looking out for the next quarter, 2 quarters, the evidence doesn't point towards a recession at all. And the markets in some way has overreacted.
You say that the Fed is reactionary in their rate hikes. So what should the Fed do you think, short and long term, to tamp on inflation?
Well, remember, the Fed's got 2 responsibilities, managing unemployment rates and manage to inflation. By increasing rates too quickly, they may lead to contraction in GDP growth, which theoretically will lead to layoffs at companies, which will then lead to higher unemployment rates. Do I see the Fed accelerating their rate of increase for interest rates today, going forward? No, because the threat of higher unemployment is definitely a risk that we have to consider.
The Fed did signal that they are going to raise interest rates in July. So do you think they're going to go even bigger based on this CPI report, or no?
No, I don't think that's going to impact their decision at all. I think they were expecting this. Again, because gasoline prices were peaking in June.
I want to switch gears now to the CPI report's impact on the crypto market. So after news broke on Wednesday of the CPI worse than expected report, the crypto market plunged. So can you walk us through the impact that report had on the crypto market?
Crypto's always been viewed as a hedge against currency risk in the USD.
Sure.
I think it's something bigger that's occurring there, which is this is tremendous leverage in the market right now, in the crypto market specifically, and in terms of capital that's been applied there. And if inflation continues to be high, interest rates are going to increase, which will lead to capital pullback that's being applied to innovation that's occurring in the crypto markets. And I think it's that simple if you think about that dynamic.
How long do you think this current crypto winter is going to last?
I think it's going to last at least through 4Q. Because we're in an environment right now where rates are increasing, which is going to lead to retrenchment, at least in the application of capital to a lot of these crypto and blockchain investments.
And looking back, do you think that this current crypto winter will rival the ones in 2014 or 2018?
I think it could certainly rival what we saw and experienced in 2018. I think 2014 was a little bit of a different animal with a lot of structural things driving that.
How was that a different animal than today?
A lot of that had to do with trust in the system in 2014, with major issues with exchanges.
So is there more trust in the system today, would you say?
I don't know if there's more trust, but the system is definitely more formalized, without a doubt. And that leads to more transparency and stability.
Before, you've been more bullish on crypto. Do you still feel that way now?
I'm very bullish on crypto long term. Absolutely, and I continue to think it should be part of everyone's portfolio with a long-term allocation. Now, I'm not suggesting people put anything more than 5 to 10% in crypto, but I do believe it should be a part of anybody's multi-asset portfolio.
What do you say to people who they have crypto in their portfolio, they've invested in crypto, and they're seeing the market, they're seeing this crypto winter, and they're feeling anxious?
I would tell them not to lose faith, but don't bet the farm on crypto either, just like I wouldn't recommend people betting the farm on an individual company or individual stock.
So I want to get into more big news of the week, and that is the euro and dollar becoming equal for the first time in 20 years.
It's a big event.
So can you walk us through how these currencies hit parity?
Sure, it's hit parity before, right, in the early 2000s, and then it broke above that and peaked in 2008. And so this is not the first time the euro and the dollar have moved towards parity. But I think this dynamic is going to change the corporate outlook for many international companies operating within the Eurozone. In particular, U.S. companies, right?
Will it be good for companies in the United States or bad for them?
I don't know if it's good or bad. You know, if we're talking about earnings, it's definitively going to depress earnings, and it's simple. You're getting now less dollars for every euro of sales you generate. Your costs are in dollars. That means your gross margins are going to be compressed, which will lead to lower ROEs and lower ROICs. So from that perspective, it's a negative impact for U.S. companies operating within Europe.
For Americans, is the dollar reaching parity with the euro good, bad, or both?
It really depends. If you're a tourist going to Europe, you can get more euros now. Certainly, I'm going to be going to Europe in a few months, and it's going to be a little bit cheaper than what it was a few years ago. For U.S. corporations operating within the Eurozone, it's going to be negative, but that's just in terms of earnings.
Economists at Morgan Stanley earlier this week said that this could indicate major financial stress for those companies. Can you elaborate on that?
Sure. It comes back to gross margin, right? You're generating your sales in euros. They're being translated back to dollars. Your debt is in dollars. So if you're servicing debt in dollars, but you're generating a certain portion of your sales in euros, you're now getting less dollars back. It'll lead to more pressure to pay back that debt. That's in basic terms what's happening there. The net of it is that the translation effect will lead to lower ROEs, lower operating margins, and lower returns on capital for these U.S. companies.
And the theme of today's conversation, obviously with the CPI report, is inflation. So will the parity help with inflation?
In the Eurozone? No, it'll probably drive it up further, right? Because now imports are going to be much more expensive. And in the export-driven economies of Europe, like Germany, they're going to be generating less in sales because of the translation effect. So no, there will be an inflationary effect in the Eurozone, which will lead to higher inflation rates.
For Americans, will it help with inflation because exports will be cheaper?
Sure, it'll help with the Americans, but if we're talking more in the Eurozone and then its natural effect in the U.S., GDP growth is expected to decelerate sharply in the Eurozone in 2023. And the ECB is going to have a lot of challenges on their hands about whether or not they raise rates to fight and combat rising inflation because of a weaker euro, while also trying to manage towards weaker GDP growth.
And does this weaker GDP growth foreshadow anything for the American economy?
Weaker GDP growth in the Eurozone, at least for American companies, could forecast lower demand for American exports. Okay. But I'm not really sure if that effect will fall in the U.S. Remember, the U.S. is driven by the U.S. consumer. Let me say that again. U.S. GDP growth is driven by the U.S. consumer, which represents 60-70% of GDP. The factors that we were talking about earlier are going to be bigger drivers of GDP growth and economic output in the U.S. than what's happening in Europe.
Stephen, thank you so much for all of your insights today and breaking down these big market stories for us. And I look forward to our conversation next week.
Thanks for having me on.